As investors begin to move offshore, there's a whole bunch of new risks to think about. Suddenly geopolitics becomes a much more important part of the investment and the risk that you have to take on. Currencies begin to come in. The companies we're looking at, by nature of their business model, are companies which are able to mitigate those risks. We're trying to find companies that, whatever happens in the world, are going to keep doing what they do day after day. It's that visibility that means whatever happens, whatever the risks are, we're comfortable that they will still generate cash and they'll still return it to you. Let me give you an example. Lots of people recently have been worried about the geopolitical tensions in Eastern Europe around the Ukraine. One of our companies, a company called Genuine Parts Company, sells spare parts and distributes spare parts to people in America when their cars break down. Whatever happens in Russia, whatever happens in Ukraine, in fact, whatever happens in China, whatever happens pretty much anywhere in the world, American cars will still break down. They will still need those parts. And if you go to the garage and you discover that your price of your spare parts have gone up by 2%, there's not much you can do about it. By investing in quality companies, it mitigates these risks. These are companies with really big global exposures. They're able to sail through any sort of FX changes. So as you begin to look offshore and discover that there are more risks out there, risks perhaps you haven't thought about before, focusing on quality companies, particularly these companies that have this proven track record of paying and growing the dividend, is a really nice way of knowing that they're helping you hedge the risks. These are not companies that are really susceptible to things changing in certain markets. The other nice thing about this strategy as you think about retirement and being able to receive perhaps a steady stream of income, when you look in the international market, fixed income yields are really very low. It's a tough place to go and get that income that you are hoping for. When you look at the dividend, the key thing about the dividend is it is not fixed income. This is a growing income. Because we're looking at trying to find companies that are going to grow their dividend at 5 to 8%, the 3.5% yield that our companies pay today, in 5 years' time, will become a 4.5% yield, and it continues to grow. And if people begin to worry about inflation in the world, it's one of the genuine fears that people should be concerned about. These are companies with great pricing power. We talked earlier that these are companies that sell products that whatever happens, you're going to keep paying for. So that means that if inflation comes through, these are companies that will be able to put their prices up along with inflation, in fact, hopefully better than inflation. They will be able to capture that inflation, pass it through in their profits, earn more money, and therefore pass it through as a dividend. And we see this through history. Dividends have tended to keep up with inflation. So we think that this is a really nice opportunity as people begin to look about, think about how they can invest overseas. Yes, there are more risks. Yes, yields look low. But we're offering the opportunity to be able to buy a good, reliable stream of income that will grow with time and doesn't fade away.